The Internal Revenue Service in the USA has stated that the official estate and gift tax limits for 2020, and they've given those out, and the estate and gift tax exemption amount was $11,580,000 per individual. It was up from $11,400,000 in 2019. That means that an individual can leave up to $11,580,000 US dollars to his heirs and pay no federal and estate gift tax, while a married couple will be able to actually shield twice that amount, which is $23,160,000. The annual gift exclusion amount remains the same at $15,000. Democratic presidential hopefuls say that they're going to bring back the estate tax limits if they get elected back into office to the 2009 levels, which were 3.5 million, with a graduated tax rate of up to 77% compared to today's flat rate of 40%. So you can see if the Democrats get back in office, they're going to basically confiscate everybody's money, it looks like. Also, most people don't know this, but if you live in one of the 15, or actually 17 states, or the District of Columbia that levy the separate estate and inheritance taxes, there's even more at stake with death taxes, sometimes starting at the first dollar of the estate. Most people don't realize this. In fact, people should be really more proactive instead of sitting on their hands and basically not resolving this problem, because a lot of people are going to be losing out a lot for their estate when they die. But okay, let's say that you, just to give you an example, you move outside the USA and you relinquish your US citizenship. There are some things that you can do. What do you need to do to avoid taxes in the USA? Well, there's actually quite a few things that you can do moving forwards. As a foreigner holding assets in the United States, you may be actually able to benefit from the investment atmosphere in the U.S., and one of them is actually leaving income-producing assets in the USA could be advantageous in several different ways, and it can also go against you. If you're a foreigner who owns financial assets in the United States and you are, let's say, not subject to the capital gains tax, this is one thing that most countries don't hit you on, is the capital gains tax on equities if you move outside that country. The U.S. also doesn't tax bank accounts. They're also tax-free. You will, however, be charged a rate up to 30% withholding tax on dividends. If there's a treaty between your home country and the U.S., then this tax treaty would be reduced anywhere from 10 to 15%. You may also recover this tax as a credit in your home country of residence. All right, now, foreigners, there's a lot of different things that you can do, but actually people don't, when they move outside the U.S. or they relinquish their U.S. citizenship, a lot of times they end up paying a bunch in income taxes because they don't really know how to shift their assets around to actually get around this. To give you an example, foreigners in America who acquire U.S. assets and then leave the U.S., and then they continue to own those assets, need to be aware of the federal estate tax rules. There's a flip side to the advantageous tax policy regarding U.S. assets held by foreigners. The U.S. imposes a 40% estate tax on U.S. assets that are above $60,000 exemption threshold on assets of the deceased non-residents. Foreign estates become subject to U.S. estate taxation with respect to their U.S. situated assets if they exceed this limit of $60,000 U.S. Now, U.S. situated assets include American real estate, tangible personal property, and securities such as U.S. companies. Non-resident stock holdings in American companies are also subject to estate taxation. To give you an example, if you leave the U.S. and you relinquish your U.S. citizenship, but you still hold Microsoft stock or Facebook or any type of U.S. equity, once it exceeds over $60,000, then the heirs get taxed over anything that's over $60,000 at 40%. Now, there are certain assets that are exempt from U.S. estate tax, which include securities that generate portfolio interest, bank accounts not used in connection with a trade or business in the U.S., and also insurance proceeds. The estate of a non-resident alien may deduct from the gross estate the value of the property passing to the decedent's surviving spouse if the spouse is a U.S. citizen or resident alien, regardless of whether the spouse lives in the U.S. or abroad. However, if a spouse is a non-resident alien, the unlimited spouse exemption does not apply. All right, now there are effects of different tax treaties. For instance, a limited number of countries have estate tax treaties with the U.S. that eliminate certain types of assets situated in the U.S. from the 40% estate taxation. But only these countries I'm going to mention to you that have a state or gift tax treaty with the U.S., they all just happen to be very high tax countries. And the reason they have these tax treaties is these countries are already charging ridiculously high taxes, either with estate or inheritance taxes in these countries. And they are Austria, Denmark, Finland, France, Germany, Ireland, Italy, Japan, Netherlands, Norway, South Africa, Sweden, Switzerland, and the UK. Even for those countries, reduction of tax exposure is really only partial. You're not going to eliminate it all, and only because you're paying taxes in those other countries anyway. A U.S. citizen who is born or naturalized in Puerto Rico, now this is an actual a resolution that you could do, and most people don't know that this is in place. I like relinquishing your U.S. citizenship actually better. There's several reasons why I like that better than Puerto Rico, but Puerto Rico is probably the best option if you're not going to relinquish your U.S. citizenship. To give you an example, a U.S. citizen who's born or naturalized in Puerto Rico and is a resident of Puerto Rico at the time of death is considered a non-resident alien as far as U.S. tax purposes. Non-resident aliens are taxed on property actually considered located in the USA. A U.S. citizen could prevent the application of the estate tax by simply establishing his or her domicile in Puerto Rico or any other possession. After the enactment of sections 2208 and 2209, any U.S. citizen resident of Puerto Rico at the time of death that acquired his or her citizenship solely by being a citizen or Puerto Rican, being born in Puerto Rico, or being naturalized in Puerto Rico will be treated as a non-resident alien for estate tax purposes. All right, given the current political situation, Puerto Rico has authority over its internal affairs unless any U.S. law has occupied the field. Under the status quo, there are some remarkable differences when the situation of Puerto Rico U.S. citizens is compared with that of U.S. citizens residing in one of the 50 states. A Puerto Rican person is treated differently for the U.S. estate tax. To give you an example, what I'm talking about, if someone relocates to Puerto Rico and becomes naturalized in Puerto Rico, you can't escape the estate inheritance tax. If you want to learn more on this, we do have other videos on this. If you're interested in getting your taxes to zero, how to get a second passport, do three things. Go to our website, www.citizenshipquickly.com, and hit the top button that says apply with us, and you get questions and fill those out. And then hit the bottom button that says send back to us, and we'll help you get started and try to solve your problem. Also, if you'll hit the subscribe button at the right of your screen, you'll get new videos as they come out automatically. And number two is I'd like to also hear from you. And if you got a question or comment, just put that below. We'll get back with you and see what we can do to answer any questions that you've got. We also deal with 74 different countries that we can help you on. But if you want to solve your problems, any taxes or getting a second passport, visit our website. We'll see what we can do to help you, and I look forward to talking to you on the next video. Take care.